Welcome to today's explainer. Today we're doing something really cool. We are stripping away all the financial noise and just going back to the absolute core mechanics of basic finance. Because honestly, even if you follow the markets every single day, it absolutely pays to master the foundation. So we're going to break down the 10 fundamental pillars of wealth to crystallize exactly how money actually works. Okay, let's dive into this. Have you ever noticed two people earning the exact same salary, yet one just slowly builds wealth while the other is constantly trapped in this cycle of financial struggle? I mean, it's wild. But the difference isn't luck, and it's definitely not magic. It really comes down to a fundamental understanding of how to manage and multiply what you have. Here is our roadmap for today. First, the foundations of finance. Second, inflation and wealth killers. Third, investing, risk and return. Fourth, budgeting and credit. And finally, the magic of time. All right, let's kick things off with section 1, the foundations of finance. So what actually is money? I mean, thankfully, we've evolved way past bartering chickens for a haircut, right? Today, we rely on currencies, like the rupee, the dollar, you name it. But here is the major mindset shift you really need to make today. Money isn't just a bunch of notes and coins meant to be spent at the mall. Think of it as a vital instrument. It's a tool that, when wielded correctly, actively builds and secures your entire future. And naturally, where does that money usually live? In a bank. The mechanics behind banking are actually brilliantly simple. First, you deposit your money for safekeeping. But then step 2, and this is key, the bank doesn't just sit on it. They lend a portion of your money out to others to buy homes or start businesses. Finally, step 3, those borrowers pay the bank interest, which generates income. It's just a continuous circulating cycle. And that fee we just mentioned brings us to our next major pillar, interest. Basically, interest is simply the cost of borrowing money or the profit you earn when you save it. Say you borrow 100,000 rupees and you have to return 110,000 rupees a year later. Well, that extra 10,000, that's the interest. Now, interest is a massive double-edged sword. When you borrow, it works aggressively against you, basically draining your wealth. But when you save or invest, oh man, it flips and works heavily for you, literally multiplying your wealth while you sleep. Moving right along to section 2, inflation and wealth killers. Meet the ultimate villain of our story, inflation. I personally like to call it the silent thief. Let's say your favorite everyday item costs 100 rupees today. Because the cost of living just naturally rises over time, in a few years, that exact same item might suddenly cost you 130 or even 150 rupees. The scary reality here is that if your income and your savings don't grow faster than this inflation rate, you are practically getting poorer every single day, even if your salary hasn't dropped a single cent. Your purchasing power is just silently shrinking in the background. And this brilliantly illustrates the absolute best way to fight back against that threat, understanding assets versus liabilities. On one hand, you have assets. These are things that actively put money into your pocket, like a rental house generating monthly income, stocks that grow in value, or a profitable business. On the other hand, you have liabilities, which constantly drain money out. Think unnecessary personal loans, massive car installments, and high-interest credit card debt. The wealthiest people out there focus almost entirely on building up their assets to essentially pay for their liabilities. All right, let's jump into section 3, investing, risk, and return. So, investing is basically the act of putting your money into assets, like the stock market, real estate, starting a business, or buying index funds, where you actually expect the value to grow over time. Let me bust a major myth right here and now. Investing is not gambling. If you want a casino, seriously, go to Vegas. Sound investing requires patience, dedicated research, and making very calculated decisions to grow your capital. But every calculated decision requires balancing 2 critical factors, kind of like a scale. Generally speaking, if an investment offers a really high potential return, it inherently carries a high level of risk. No way around it. Conversely, a very safe, low-risk investment is going to offer a lower return. There is absolutely no such thing as a totally risk-free investment with massive returns. You have to balance that scale according to your own personal tolerance for risk and your specific goals. Next up, section 4, budgeting and credit. Now, what's really interesting here is how simple budgeting can actually be if you use the famous 50-30-20 rule. It's a game changer. You just take your after-tax income and divide it up. 50% goes to your absolute needs, rent, groceries, keeping the lights on.
30% goes to your wants, dining out, entertainment, all the fun stuff. And a strict, non-negotiable 20% is immediately carved out for savings and investing. This framework naturally prevents overspending and makes absolutely sure you pay your future self first.
Alongside a solid budget, you also have to manage your reputation with lenders, and that is your credit score. Think of this as your permanent financial report card. It's a number that represents exactly how reliable you are at repaying borrowed money on time. If you continuously pay your bills and debts on schedule, your score goes up. A high credit score makes it significantly easier and way cheaper to secure necessary loans in the future, like if you ever want a mortgage for a house. So please, protect this number at all costs.
And that brings us to our final stop, Section 5, the magic of time.
Picture this. You've got two friends who both decide to invest $10,000 a month. The first friend gets a head start and begins right at age 22. The second friend waits a whole decade and starts at age 32. Even if they get the exact same rate of return on their investments for the rest of their lives, the person who started at 22 will end up with a massively larger pool of wealth by retirement. That 10-year head start creates a gap that is almost unbridgeable. Why?
Because of compounding. Compounding is this incredible principle where your money earns interest, and then, here's the magic, that interest earns its own interest. It creates this massive snowball effect over time. The more time you give your money to roll down that hill, the faster your wealth can exponentially grow. Time is the ultimate multiplier for your investments. Honestly, the best time to start was yesterday. The second best time is right now. So as we wrap up this journey, let's distill all of this into a really clear, actionable checklist. If you want to master your finances, save first, then spend what is left. Avoid unnecessary high-interest debt like the plague. Start investing as early as humanly possible to capture that magic of compounding we just talked about. Constantly look for ways to upskill and increase your primary income. And finally, never stop learning. The financial world evolves, and so should your knowledge. So, knowing everything we just covered about inflation, assets, budgeting, and compounding, I really want to leave you with this one thought. If you only had 1,000 rupees in your pocket today, what is the very first financial move you would make? Think about it carefully. It's actually the perfect question to transition us into our next explainer, where we're going to dive into exactly how to start investing with minimal funds. Until then, keep learning and start putting these pillars into practice.